Hi, I'm James Dunn. Welcome to the Inside Network. Joining me today to discuss generating resilient income is Roy Keenan, co-head of Australian fixed income at Yarra Capital Management. Welcome, Roy.
Hey James, good to be here.
Pleasure to have you. Roy, we saw rates over a very long period of time go down the stairway and they took their time about it to extended lower rates, but then they got in the elevator and went straight back up to normal levels, or what we thought of as normalised levels, very quickly. So how has that rapid inflection affected your portfolio construction? Where are you adding overweights and where are you significant underweights?
Yeah, so look, I think when you're constructing a portfolio and you have these sort of moves in interest rates, you sort of think, well, who are the winners and losers? And the way we've thought about the recent rise in interest rates is about, who is the best place to actually absorb those interest rate rises. And we've been really keen to be long banks. Banks have lots of capital, they have lots of ability to cut costs, and we've seen even the big surprise probably since rates have risen has been how little arrears has built up in the system. So that sort of was a testament to the strength of the economy. We like the insurance sector. The insurance sector, as everyone knows who has an insurance policy, premiums have been rising quite rapidly. Cost inflation on the claim side, but insurance companies are really making really good returns on their investment books. The one area that we've probably avoided has been really anything to do with sort of office REITs, any part of the real estate market where we think there's risk from actually falling property prices and any sort of cyclical problems that are there.
Now, higher interest rates means higher borrowing costs for corporates. So how well prepared do you think the market is for the inevitable elevated default risk that brings?
Yeah, it's a really good question, and probably in the 22 years I've been managing the Yarra Enhanced Income Fund, we're probably running the highest credit quality that we've ever had in the fund. And in some ways that's a strategic decision, and it comes back to a couple of things. IG companies, investment grade companies, have really strong balance sheets, have less borrowing, and can actually adjust quickly to rising interest rates, and they have a lot more pricing power. Any corporate that has higher yield type, a higher yield from a credit rating point of view, have much greater levels of gearing, have less pricing power, and are much more susceptible to higher interest rates. And you're right, we think that you can't sort of have this move in interest rates without some sort of problem in the economy, and we do expect some sort of default risk to sort of hit the marketplace. We think it potentially could be in real estate. There'll be pockets of real estate that will suffer, but there will be also levered companies who have been levered 4 or 5 times, maybe 6 times off the real lower interest rate environment. But now their interest rate on some of that debt's gone from sort of 3.5 to sort of 8. It's problematic. So that's why we're sort of really concentrating on sticking to sort of the IG as opposed to high yield.
Yarra looks to diversify risk through its portfolio construction process. Can you take us through that process and particularly how you think about position sizing?
Yeah, so when we're thinking about investing in companies, we're obviously taking the macro environment and looking from a top-down process perspective, but also then looking at our bottom-up analysis of companies. And we apply our own internal credit rating at Yarra. And once we've done that sort of process, we will then look at that underlying internal credit rating and we'll construct a portfolio based on what the value of that security is offering. But more importantly, we will look at things like, if I use the example of one of the major banks, obviously very high credit quality, we're more likely to have a bigger allocation across our portfolios to higher credit quality companies. As we move down the credit quality in a company, we are less likely to own as much of that security, and then more so in that sort of rating bands, looking for more diversification. So in some ways, happy to invest more in high quality. Yes, it's a little bit less return, but when we are going for higher returns, we'll tend to less and be diversified more.
Your team's work is a mixture of quantitative analysis and qualitative assessments. Can you take us through that and how Yarra sees active management assisting in this task of protecting investors' capital?
Yeah, we're constantly analysing where's the best place to invest. And you're right, some of that's quantitative and some's qualitative. If I use like the bank capital structure, for example, we currently see in the current bank capital structure where we could invest in senior, tier 2 and tier 1 of a major bank or insurance company. We tend to think today one of the best places to invest is in tier 2 relative to tier 1 and senior. And that in some way it comes back to a bit of our analysis of the risks, and probably the key thing that we think about is getting paid for the risk that we're taking. And we feel that that analysis, the moment you're sort of not getting paid for the risk you're taking, you shouldn't be investing in those types of companies.
Ultimately, advisors want to see their clients enjoying healthy levels of income, particularly in retirement. What are the key considerations in achieving that?
Yeah, look, it's a really good question. We feel today that we're sort of moving into an environment which is probably higher for longer, which is great for income generation. I think the key for us is that, given that we're probably positioned in the highest credit quality at the moment, we don't feel you need to take a lot of risks to get a lot of really strong returns at the moment. And so from my perspective, generating income, and protecting income is going to be really important over the next 12 to 18 months. If I think about where you can make a mistake in generating income is chasing too high a return, because in some ways if you're chasing too high a return from an income perspective, you're incorporating a lot of risk, and I just don't think it's the right time to be doing that at the moment. I think that as an active manager, I think it's never been, probably in the last 10 years or so, I don't think you've seen a better period for active management in fixed income. Yes, there was a case when we had really low interest rates for sort of passive investment, but I think times have changed. We've come to a more normalised market, and in some ways I'm really excited about the opportunities going forward.
What about the correlation question? In 2022, people obviously saw bonds and equities turn positively correlated.
Yeah.
Everyone freaked out as though that was a law set in stone, whereas if you'd look historically back 20 years ago, it wasn't. So if people are expecting that negative correlation to return anytime soon, what's your views on that with respect to with government bonds and credit? Can credit continue to help in that diversification role?
Yeah, absolutely. I'm a big believer that that sort of positive correlation with equities can't continue. I think it will return negative, and I think that's more that return to more normal markets. I think the key with credit and equities and that argument in bonds is that, I think what you'll see is that people who are investing in the equity market will see that there is sort of almost equity-like returns in debt and in credit. And that sort of step up in risk, especially if you're looking to generate income, consistent income, is the way to go. I think when you come to government bonds, I think what you'll see over time is that, yes, inflation will come down, growth will be lower, could be problematic for equities. It's going to be very hard to call that, but I think any environment where higher for longer is the key theme will be problematic for growth assets.
This has been In Depth with Roy Keenan, co-head of Australian Fixed Income at Yarra Capital Management. Thank you very much, Roy.
Thanks, James.